Welcome back to Investing Talk Podcast.
Today we're looking at PayPal. And honestly, calling this a critical moment might be the understatement of the year. We are looking at a stock that is moving fast and, well, definitely not in the direction most holders wanted following that Q4 2025 earnings report that just dropped yesterday, February 3rd.
As usual, before we start, subscribe, like, and comment to this video to support the show. We really do appreciate the engagement. Now, looking at the screens this morning, it is ugly out there.
It's a sea of red.
It really is. I'm seeing words like crash, plunge, disaster, and, the CEO is stepping down, the stock is gapping down. It just feels like the sky is falling. To me, this looks like a classic falling knife situation.
Yeah.
And you know the rule about falling knives, right? You don't try to catch them or you lose a finger. Why would anyone want to step in front of this train right now?
I get the fear. I really do. You wake up, you see those bright red candles on the chart, and, the lizard brain just takes over and screams, sell. But I want to counter that immediate panic with the so what question we have to ask. Is the market overreacting? Because when you look past the panic, you see a massive changing of the guard with the new incoming CEO, Enrique Lores. You see a business that, despite all this noise, is just printing cash. So our mission today is to figure out if this sell-off is actually a fire sale, a buying opportunity, or if the business is, fundamentally broken and heading for zero.
That is the million-dollar question, or maybe the billion-dollar question in this case. You say they're printing money, but the headline numbers, they suggest they're missing targets.
Yeah.
And in this market, if you miss, you get punished.
We do.
So let's strip away the emotion. Let's look at the cold, hard facts, the fundamentals.
Let's do it.
Okay, so starting with the top line, Q4 2025 revenue came in at $8.68 billion.
Right.
Now, on the surface, that is up 3.7% year over year. In a vacuum, growth is growth. But Wall Street doesn't live in a vacuum. The Street was looking for $8.78 billion.
So they miss.
A clear miss. Then you look at the bottom line, the profit. Adjusted EPS, earnings per share, came in at $1.23. The expectation, $1.29. They missed again.
It was a double miss.
Exactly. And here's my problem. For a company that is priced as a growth stock, or at least a company that management claims is a growth stock, missing both top and bottom lines is a massive red flag. It's like a sprinter tripping right out of the starting blocks. It just tells me the engine is sputtering. Why should investors forgive a miss like that?
See, I think you're focusing a little too much on the growth label and not enough on the value reality of what it's become.
Okay.
You're right. They missed the consensus by a few pennies. But if you dig a little deeper, look at the profitability metrics, specifically adjusted EBITDA.
Earnings before interest, taxes, depreciation, and amortization.
Yeah.
The pure operating profit.
Exactly. It actually beat estimates, coming in at $2.02 billion. That's a 23.2% margin. I mean, that is not a company that is sputtering. That's a company that is becoming incredibly efficient.
Okay, so they're squeezing more profit out.
They really are. And we have to talk about the guidance, because that's what really matters for the stock price tomorrow.
The guidance is usually where companies try to, hide the bad news. Ignore what we just did, look at what we might do.
Right. But in this case, the guidance is actually pretty solid. For the full year 2026, they're guiding EPS to $5.75.
And the consensus was?
But the consensus estimate was $5.73. So despite the stumble in Q4, management is basically telling us we see stabilization. They are actually guiding slightly above what the Street expected for next year.
So they're not lowering the bar.
They're not. It tells me the internal data might be stronger than that one messy quarter suggests.
Okay, fair point on the guidance. If they can hit that $5.75, the stock does look cheap. But I want to drill down into what I call the problem child of this report. We can't ignore it. It's branded checkout.
The PayPal button.
The button.
Yeah.
The core identity of the company. It only grew 1% on a currency-neutral basis.
Yeah.
1%. I mean, let's be real here. Inflation is running higher than 1%. So in real terms, their core business is actually shrinking.
It's a decline.
Yeah. They're citing U.S. retail softness and international headwinds. But to me, that just sounds like corporate speak for we are losing market share. If the core product isn't growing, isn't the company just slowly dying? Is everyone just using Apple Pay?
That is the big fear, right? The obsolescence risk.
Yeah.
That they just go the way of the fax machine. But I have a counter argument, and it's a big one. It's the cash argument. You just cannot ignore the free cash flow.
Okay.
We are looking at a trailing 12-month free cash flow of $6.71 billion.
$6.7 billion. That is a massive pile of cash.
It is enormous, and context matters here. That number is up 99% since 2019. So while everyone is screaming that the company is dying, the company has literally doubled its cash generation capability in the last 6 years. It is a cash-generating machine. And, it's not just the legacy business. You have enterprise payments showing double-digit volume increases, and then there's buy now, pay later.
BNPL. Everyone loves BNPL right now. It feels like the only part of fintech that's actually working.
Because it is working. They're projecting a 24.3% compound annual growth rate, KGR, through 2030 for that segment. So here's the picture. You have this mature cash cow business in the branded checkout that, while it's boring, is funding these high-growth engines.
I hear you on the cash flow. $6.7 billion buys you a lot of time. It buys you a lot of mistakes.
Yeah.
But does it buy you a moat? I look at Stripe, I look at Block. Does PayPal still have a defensive trench around it?
I'd argue the moat is the network effect, and it's bigger and stickier than people realize. I mean, 439 million active accounts. In Q4 alone, they processed 6.8 billion payment transactions.
Wow.
Think about the friction of leaving that ecosystem. If you're a merchant, you can't afford to just turn off a button that 439 million people use. The switching costs are really high.
They are high, but they aren't infinite. I acknowledge the scale. But my worry is those users are stagnant. But, okay, the books are messy. It's a mixed bag. Let's pivot to the charts and look at the damage.
Yeah, we have to look at the technicals because the price action, it tells a story.
Visually, this is a horror show. We are seeing sharp downside momentum. The stock is, for lack of a better word, crashing post-earnings. And sure, the NASDAQ is down about 1.4% broadly, so tech is bleeding. But PayPal is leading the way down. We have a massive gap down on the chart. This looks like a flesh-out phase to me.
It definitely looks like a flesh-out, but that's exactly where things get interesting for, a contrarian investor. Look at the volume.
Volume on the drop.
Exactly. We're seeing massive volume spikes with this drop. And for our listeners, volume is just the number of shares being traded. In technical analysis, high volume on a sharp drop often signals capitulation.
Capitulation.
Yeah.
That's a fancy word for giving up.
That's all it is. It means everyone who was thinking about selling, everyone on the fence, has finally panicked and sold. The weak hands are out. This creates what we call a contrarian oversold state. Think of market sentiment like a rubber band. You can stretch it down towards panic, which is what we're seeing, but eventually it has to snap back.
So you're saying the rubber band might be stretched too far?
Potentially. Provided, of course, that operational fixes arrive. But technically, when you are this oversold, the bounce can be violent.
I'd be more convinced if I saw the smart money stepping in.
Yeah.
I'm looking at the institutional data, and it's quiet. I don't see any recent Form 4 cluster buys.
Can you just clarify that for the listeners? What is a Form 4?
Right, good catch. A Form 4 is a document that corporate insiders, CEOs, CFOs have to file when they buy or sell stock with their own money. It's the ultimate skin-in-the-game indicator. If the CFO is buying, he probably knows something good is coming. I don't see that here. And I don't see any 13F accumulation either from the big funds. If this was such a steal, wouldn't they be backing up the truck?
That's a fair critique. Insiders aren't buying on the open market yet. But remember that free cash flow number, that's $6.71 billion. The company itself has the liquidity to support the stock price through buybacks.
Oh, okay.
They don't need insiders to buy with their personal cash. The company can buy back its own stock with that massive war chest. It provides a floor that a lot of other crashing tech stocks just don't have.
That is true. They can be the buyer of last resort. But let's check the pulse of the market. Let's see what the market vibe is moving to sentiment. Because right now the vibe is, well, it's toxic.
It's definitely heavy.
I'm reading the room here, and the mood is overwhelmingly bearish. I'm just scrolling through the news feed. Listen to these. Why PayPal stock crashed today. PayPal plunges after earnings miss. Weak 2026 profit outlook.
It's a pylon.
It's a total pylon. Then you add the uncertainty of the CEOs stepping down. Markets hate uncertainty, even more than bad news. It feels like a ship without a captain.
That is the narrative in the press, absolutely. But let's contrast those headlines with the people who are paid to analyze the math, the Wall Street analysts.
Okay.
Despite the crash, despite the plunge headlines, the analyst consensus remains a moderate buy. They haven't abandoned ship.
Really? They're sticking with it.
They are. In fact, if you look at the median price target, it's sitting at $71.54. Now, compare that to the levels we're seeing today. That represents a roughly 28% upside.
Wow.
So the headlines say, run for your life, but the math says there's almost 30% upside here. That's a huge disconnect.
That is huge. Why are they holding the line?
I think they're waiting on the leadership catalyst. We have the interim CEO, Jamie Miller, but everyone is really looking at the incoming CEO, and Enrique Lores.
Enrique Lores, let's talk about him. He comes from HP, right?
Exactly. And that context is so crucial. HP was a legacy tech giant, a dinosaur, a printer company in a digital world. Lores was the CEO there, and he extracted massive value. He focused on cost-cutting, efficiency, and modernizing a legacy brand. Sound familiar?
Sounds exactly like the situation at PayPal.
Precisely. The market is waiting to see if he can drive relentless execution. That's the phrase people are using. The belief is this isn't a broken business, just maybe a mismanaged one.
So it's a management turnaround play.
Exactly. And there's some unconfirmed chatter that Lores is going to accelerate the branded checkout updates with things like biometrics, PayPal Plus rewards. If he can modernize that core product, sentiment could flip overnight.
If BIC is doing a lot of heavy lifting there. Turnarounds are hard. Okay, but we have to look at the risks. Let's do the bear case.
Lay it on me. Steelman the argument against buying.
Okay, here's the nightmare scenario. Execution risk. That 1% growth in branded checkout. If that number goes negative, if it turns into negative 1% or makes it to 2%, this stock is dead money. I don't care about the cash flow. Wall Street will treat it like a melting ice cube.
And competition is fierce.
It's brutal. And let's talk user experience. When I use Apple Pay, I double-click my phone, and I'm done. 2 seconds. With PayPal, sometimes a window pops up, sometimes I have to log in. That friction is where they are losing. Convenience always wins.
That is the existential threat. Friction is the enemy.
Then there is the 2026 profit decline. The guidance allows for a potential low single-digit EPS drop in the short term to fund growth investments. But investors hate investment years. We don't want to hear we are spending money now to fix the problems we caused.
I see that differently. I'd argue that risk is priced in. Look at the chart. The market has already punished them for the investment year. At this valuation, you aren't paying for perfection. You're paying for a fixer-upper.
Okay.
And I think that diversification into Venmo and BNPL provides a safety net. Venmo is still a verb. BNPL is exploding.
One more bear point, macro. If we get a recession, consumer spending drops, period.
Yeah.
PayPal makes less money. You can't execute your way out of a recession.
True, but you have to look at the secular tailwind. Digital payments are projected to hit $36.75 trillion globally by 2029. Trillion.
Wow.
Even with a recession, the shift from cash to digital continues. PayPal just needs to ride that wave. They don't even need to beat the market. They just need to not drown.
Okay, we've looked at the good, the bad, and the ugly. The cash flow, the leadership change, the terrifying chart. It's time for the final verdict. Where do we land?
It's time for the final verdict. I've crunched the numbers, weighed the sentiment, and looked at the technicals. I am assigning a bullish score of 7 out of 10.
7 out of 10. That's pretty confident given the blood in the streets. Walk me through the final thesis.
The thesis is simple. It's a value play. You have a massive network, 439 million users, and a cash flow surge to $6.71 billion. You're getting that asset at a steep discount because of a bad news cycle.
So you're buying the fear.
I'm buying the cash flow and the network. The catalyst is the incoming CEO, Enrique Lores. If he drives even a moderate turnaround in branded checkout, combined with that hidden growth in BNPL, the stock re-rates higher. It doesn't need to be a growth darling. It just needs to be stable.
What's the strategy then? Do you buy today?
I view this as a swing trade into Q1 earnings in late April. You play the oversold bounce, that rubber band snapback. If the execution improves, you can scale it into a multi-year hold. But initially, you are playing the rebound from an overreaction.
I have to admit, the logic holds up. It's risky. But that $6.7 billion in cash flow provides a floor that makes me sleep a little better at night. It prevents the stock from just going to zero.
Exactly. It's a calculated risk with a clear safety net. That's the thesis for PayPal.
Well, there you have it. Make sure to subscribe, like, and comment to this video to support the show. We'll see you in the next one.